Hello and welcome everyone. This is Shivangi Dhawan. Today, we will be discussing Excel applications in capital budgeting decisions. Capital investments are long-term investments in which the assets involved have useful lives for multiple years. For example, constructing a new production facility and investing in machinery and equipment are capital investments. Capital budgeting is a method of estimating the financial viability of a capital investment over the life of the investment. Unlike some other types of investment analysis, capital budgeting focuses on cash flows rather than profits. Capital budgeting involves identifying the cash inflows and outflows rather than accounting revenues and expenses flowing from the investment. Over the long run, capital budgeting and conventional profit and loss analysis will lend to the similar net values. However, capital budgeting methods include adjustments for the time value of money. Capital investments create cash flows that are often spread over several years into the future. To accurately assess the value of a capital investment, the timing of the future cash flows are taken into account and converted to the current time period. There are several capital budgeting analysis methods that can be used to determine the economic feasibility of a capital investment. There are traditional methods and modern methods. When we talk about traditional methods, the most famous methods are payback period and average rate of return. And when we talk about the modern methods of capital budgeting, we have net present value, profitability index, internal rate of return, discounted payback period, modified internal rate of return. We will be discussing each of them one by one in our videos. Today, in this video tutorial, we will be understanding Excel applications in capital budgeting decisions by payback period method. Payback period is a simple method of capital budgeting. It represents the amount of time required for the cash flows generated by the investment to repay the cost of original investment. For example, assume that an investment of 600 will generate annual cash flows of rupees 100 per year for 10 years. The number of years required to recoup the investment is 6 years. So, the payback period analysis provides insight into the liquidity of the investment, the length of time until the investment funds are recovered. However, the analysis does not include cash flow payments beyond the payback period. That is one of the limitations of the payback period method. So let's see how to solve the question using payback period method and to check whether the project is feasible or not. So we have a question here, which is like a project requires an outflow of rupees 40,000 and the expected cash inflows generated from the project are 10,000, 12,000, 10,000, 7,000 and 5,000 for the next 5 years. For the next 5 years. Calculate payback period. So here, we need to understand that the payback period is the length of time for an investment to recover its initial outlay in terms of profits or savings. So when you are having equal cash flows generated every year. That is, when the cash flows are in the form of an annuity, then your payback period is very simple to calculate. That is, initial investment divided by annual cash inflow. But when your cash inflows are not equal or they are unequal, then payback period can be calculated using the formula P plus B by C, where P is number of years immediately preceding the year of final recovery, B is balance amount to be recovered in the year of final recovery, and C is cash inflow in the year of final recovery. For your understanding, I have written both the formulas here. That is where there is equal cash flow and where there are unequal cash flows. The formula of calculating payback period differs. In this case, it is clear that it is a case of where their cash inflows are unequal. So we will be using P plus B by C as the formula. If we see the question again, we are having 5 years, 1, 2, 3, 4, 5. Cash inflows are given to us. So the first thing we need to do is to calculate the cumulative cash inflows. So here we have written is equal to B17 as self-referencing of 10,000, and 12,000 is the second cash flow. So the cumulative will be 12,000 plus 10,000, that is 22,000. So we have given this formula of C17 plus B18. Okay, that is 10,000 plus 12,000, and we can drag it down to get the other cumulative cash flows. So we will be dragging down this figure. So for your understanding, I am doing it again. So here it is B17, that is this one, and we have written is this like 10,000, and for the second value, it will be this plus this and enter. And for the other values, you can only drag it down and you'll get all the values like this. So this is how we do it. So after getting this, you can see that till the end of 4 years, we are receiving only 39,000, where our initial cash outflow was 40,000. So our payback period will be P plus B by C, where our P will be number of years immediately preceding the year of final recovery, that is 4. Balance amount to be recovered in the year of final recovery. So we know that our amount will be recovered in the 5th year, and the amount that is remaining, that is the balance amount, is 40,000 minus 39,000, that is only 1,000. And C is cash inflow in the year of final recovery, that is our year of final recovery is the 5th year, and in that year our cash inflow is 5,000. So this is how we will be writing down the formula. So for it, I will zoom it a little for your clarity. So here it is. P is 820, that is 4 plus bracket 1,000, that is the balance amount to be recovered in the year of final recovery. So we only need to recover 1,000, as we have already recovered 39,000 and we are left with just 1,000 to recover 40,000 in total, divided by cash inflow in the year of final recovery, that is 5,000. When you enter, you'll get that you will recover your amount or the length of time in which your investment will recover its initial outlay in terms of profits or savings. It will be 4.2 years. I hope it is clear. Thank you so much for watching.